If you look at 2000, let's go back a few years before. So we had that hedge fund that had a bailout on 1998. Then the house bubble officially started in 1998, and then that's when the housing bubble started in 1998 as well. And simultaneously, you had a ridiculous amount of optimism with every company that was making computers or anything related to computers or the internet. And by this time, which is a bit funny, this was the impeachment of Bill Clinton. Yeah. Wasn't that 99? Yeah, 99. He was facing a trial. That's when the housing bubble started. And then that's when people acquired risk-free mortgages and loans. What really kick-started it was that I can't remember the individual name, but there was this guy in 92, 91, and he had an idea of the subprime mortgages. And it was a perfectly fine idea. It was a pretty productive idea. But as it went on to excess amount and where everyone was doing it, where there wasn't controls, where there wasn't boundaries to limit the amount of usage, and where they saw, it's like standard finance. When you use too much leverage, it's not good because it's very risky in terms of especially properties that you're buying things that are not worth that, and you're giving people a sale that's not worth the actual value. And that's what was going on. And you're giving potentially loans that are very risky loans if you have everyone using that loan. And that's what was going on. And that started to become more of a thing towards the 99, 2000. Of course, it got worse by 2001, 2003, 2005. And it peaked at 2006, and that's when it fell down. But during 2000, the dot-com bubble crashed. 9/11 happened a year later while Enron went under, and greed was continuing to go on into the subprime mortgages. It is a very terrible mixture year. It was a terrible year for the markets and in Wall Street, but it was a great year to buy because you have a lot of macro events happening that won't affect a sustainable business. For example, is this event going to affect Coca-Cola? Is this going to affect the way how people drink Coca-Cola the day after? No. Are people going to still drink Coca-Cola after 9/11? Yes. I know that sounds terrible event, but this is normal. I mean, it's like World War III. Are people still going to drink Coca-Cola after World War III? Now, of course, if the world ends, no, but people will still drink Coca-Cola in their bunkers. Will people still drink Coca-Cola if Enron went under? Absolutely. Enron has nothing to do with even a business similar to Enron. Nothing to do with it. And will people still drink Coca-Cola or eat McDonald's if people are getting this risk-free loans on the housing market? Yes. This is why I don't invest in stocks, but I invest in businesses, because businesses have nothing to do on macroeconomics. They don't. I'm sorry to break it to you, whether you love that that's the way, but it's not like that. Because Apple does not make more money because there's lower interest rates and there's low amount inflation temporarily, or there's some geopolitical issue. No, it does additionally make it a little bit more money, but Apple does not sell 100% more products than what they did yesterday because of macro events. They sell based on tactics on that they induce in the product that they currently have by making it more valuable. That's by creating more features, more competitive features within the product, most of all, more friendly user interface, a better platform to get all the compatibility you can in that iPhone. What does this have to do with macroeconomics? That's why you never invest based on macroeconomics, but I know a ton of people who do. And that's why you don't need to know about a crazy prediction, because predictions are utterly useless. A prediction on the market is like predicting that there's going to be a rain continuously every day for the next week, right? I could be somewhat right, but I can't be completely right. And it's utterly pointless, because it's a much more productive way to say, in this year, it's going to possibly rain. It's going to possibly be sunny, and hell, there might be some sort of earthquake or something like that. And you mix all the realities, right? And you profit based on each scenario. That's the point. That's how you make money in the markets. It's not by getting all into one different prediction. And so by 2001, there was the War on Terror, which basically made a program and where the U.S. was fighting every terrorist organization. That happened in 2001, obviously, from 9/11. And by 2002, during these years, there was big distrust now with tech companies, obviously, because everyone's discouraged after a lot of them are not even making money, lower earnings, and distrust on tech companies. And then by 2003, America's families and small businesses have more money to spend. save and invest because the president proposed in law of act 91 million taxpayers, a tax cut of 1,126. Yeah, this is just taxes. And then according to the Department of Treasury, without the fiscal measures implemented under Bush, there would have been as many as 2 million fewer jobs of American workers today. Yeah, I remember he induced workers, especially after 9/11, so that was a great thing that he did. America's economy grew at the strongest rate in almost 20 years in the third quarter of the year. 328,000 jobs have been added over the last 4 months, the most robust 4 months job growth record in nearly 3 years. More manufacturers are reporting an increase in orders that at any rate or time during the past 20 years. Now, is this the reason why I invest? No. Even if there's a booster of research and a booster of saying that the economy is growing at a big level, why? Because the stock market's not the economy. And also because is the economy gonna make Apple extremely, like, for example, Apple right now is worth about $2.6 trillion in its market cap. Is Apple going to be worth $6 trillion in the future just because there's a lot of strong job growth? Not at all. Is it because there's lower interest rates with strong growth? No. Sure, Apple's going to make money, a slight bit of money on that, but that's not the sole reason why they're going to make a big amount of profits to what they currently have. It solely has to do with their business. What are they selling? That's why I don't invest in businesses that I seem are good. I only invest in businesses that are the best. And that's how you should invest, because there's a lot of people that like to invest in good businesses, but they're more enticed to invest just because it's a good macro time. And these people buy and sell, and there is no right way, right? I'm not in the markets. There is no right way. That's the whole freedom about this. From what you're getting from me, you just try to push out what you want it to be. But what I found to be very successful and very powerful is only investing by just the business. There's a lot of people in Wall Street that like to invest based on macro factors, and you could get some good results with that, but it's an unnecessary headache, and it's not necessary. It's like, think about it like this. If you were driving in a highway, right, and you had to get to destination A when you're in destination B, let's say you took a route that had so many zigzags and so many places to go just to go to place B, and that area took around maybe 10 turns in a row. But you saw on destination 1, that was destination 2, you see on route 1 that you can just drive straight ahead and you will get there 10 minutes or 20 minutes before the other area. That's the same exact way how at least I perceive it to be when I hear people invest on macro, or how I do. Why? Because by nature, when you hold a company in the long term, you're always going to make more money than the person trying to invest in a company that's somewhat good, but it has a good macro time, because you can't hold that company because you're just going to sell it, right? But when you sell something, you're not earning still. That's the beauty about investing in businesses. It's the fact that if I invest in Coca-Cola in 30 years and Coca-Cola is even better in 30 years, then I have no reason to sell Coca-Cola. I can still hold Coca-Cola and I'll make more and more and more and more money. And it's a good get to go business. It's a good investment. I'm not saying that Coca-Cola is a good investment to everyone, but I'm just saying, like, that sort of structure, right? If you find a quality investment as an example like that, there's no reason why you should exit and try to find a better investment. That's going to be harder to do, especially that you've earned dividends and all these type of things. You're going to see to be more profitable in holding than just selling. Why? Because what are you going to do with the cash when you sell? You're likely going to invest it again. What's the point of investing again if you can just hold it? Well, it makes more sense. That's the point with that. Then by 2004, GDP grew. A lot of good things happens. That always happens after a crisis. That the economy grows a lot after the crisis. That's why you always want to buy in a crisis, because every single time, that's when people are starting to see the value that the business has always had there, despite macro. That's what I do. I invest when people don't think it's good, when people think based on macro, but I invest behind the scenes when it's so dirt cheap that I know that I'm buying such at a cheap price and people will jump in the boat. Basically, I'm buying where the market maker also buys, in a way. Real GDP grew 4.4% in 2004, the strongest since 1999. The industrial production at an index of 115.5 rose above the 2000 high of 115.4, with gains in major categories except mining. The capacity utilization rate of 78 was the highest since 2082. Manufacturers' new orders of 365 billion reached a new high. So yeah, the GDP was really growing by that time. That's what we're getting out of that. And if we look at this website and where we can find unemployment, GDP, and inflation, you can see that by 2003, unemployment was at 5.7%. It wasn't so high. GDP was going up ever since the dot-com bubble burst. and inflation rose a little bit, but inflation is at a normal level. It's not high. Why? Because inflation usually moves within the range of 3 to 4%. Right. So when I hear people say that inflation is so high at 5%, they're only thinking of what's happened in the past 10 years. But if you looked at what's happened in the past 40 years, inflation's supposed to be at 3%. When inflation's at 1%, that's very low. That's really no inflation. But at any rate, in 2003, right, so I'm going to look at the S&P 500, and that's just because the S&P 500 became more relevant towards the 21st century because we had more companies to deal with. You had companies now in tech, new consumer discretionary like Nike. You had, most of all in tech. And then you had industrial, energy, a lot of these older companies, consumer defense, all this stuff. So we're going to look at the S&P 500. The S&P is not so different from the Dow Jones, but I just want to look at this because it factors more of the, let's say, the volatility, and it's going to be an area where you guys are going to invest in more. I could have looked at the S&P 500 back in the 60s, like what I did with the Dow Jones, but it really was the same, right? Just with more, it just was more consolidated because there wasn't much companies to add in the S&P because there wasn't the most strongest full companies in this time. There was a few strong companies, but there wasn't to the extent that there is now because of innovation, right? But you can see it was the same. Remember by the 80s, the market went down. By 77, same. By 73, remember the oil crisis? You see, it's the same as the Dow Jones. So let's look at, we're now in 2003. Okay, so the market went up in 2003. This is when the housing bubble completely just flew off, and people were, waiters had like 4 properties. It's crazy. This is when the housing bubble burst. Market corrected, but it went up because it didn't even care. This is with businesses, not house, not real estate. Until banks that weren't involved in real estate, really big banks like Lehman and even JP Morgan, but most of all the ones who were so stupid into putting everything into these dumb loans by just being greedy was Lehman and the Washington Mutual Bank. And some other small banks that I'm pretty sure, but those were the biggest. They were the biggest banks in the world. By 2007, on October 11th, that's when the market peaked and it completely crashed for a year and a half. And this is now 2008. We're now in 2008. Let's see what happened. Well, really, the housing market bubble burst in 2000, like the end of 2005. And let's look at the data here. By 2005, unemployment was at 4%. In fact, it was going down, even in the housing market. Well, GDP went down from the housing market, crashed, and inflation went down until inflation went up by 2007, but it wasn't normal. Inflation was normal at this time. Yeah, so there wasn't any key areas there. It was most of all was real estate. If we look at this, okay, so what drove 2003 and 6 housing boom? Well, we already know it was the subprime mortgages of what they started, but let's try to delve down into exactly what parts affected each other and made it a bigger problem as it went on. Economic growth and job growth both fell in 2006 from previous years as the residential housing boom came to an end. The slowdown in employment growth and economic opportunity was homegrown as consumers saw rising debt payments on the record debt built up in past years. This debt squeeze leaves less money available for key households expenditures and is already beginning to push many hardworking families over the edge amid rising loan defaults and bankruptcies. The stock market and housing market crashes of 2008 traces their origins to the growth of subprime mortgages. Bubble began in 1999. Fannie Mae, that's who the ones who induced the effect of this bubble, was Fannie Mae and Freddie Mac made home loans accessible to borrowers who had low credit scores and higher risk of defaulting on loans. That was the whole point of subprime mortgages. These subprime borrowers were allowed to take out adjustable rate mortgages with low starting rates that would increase after a few years. So they would take out those rate mortgages with already lower rates, and that would automatically increase over the years to come. Financial firms were the ones selling these subprime mortgages to large commercial investors in pools of mortgages known as mortgage-backed securities. By the fall of 2008, this is important to understand, these mortgage-backed securities were bought by a lot of investment managements that were owned by banks, by like Lehman Brothers, like the Washington Mutual Bank. And unfortunately, what happens with banks, not unfortunately, but that's what you need to learn in 2008, that banks by nature, to make money, obviously a bank makes more money by the more deposits it has, right? Because the more deposit it has, the more capabilities it has to leverage it out, right? And that can be by loaning it out or by investing that money into securities. And a lot of banks in that time, not every bank, but a lot of banks like Lehman Brothers and the Washington Mutual Bank, almost all these deposits into mortgage-backed securities, especially these subprime loans, because it was an easy money that everyone was utilizing loans and were coining money in that way. And that's super dangerous because they don't care about the risk of defaulting or not sustaining that valuation that's not even there. And then by the fall of 2000, similar to cryptocurrency. So by the fall of 2008, borrowers were defaulting on subprime mortgages in high numbers, the collapse of the financial markets and the global recession. And so subprime mortgages are mortgages that were made to borrow with less than perfect credit and less than adequate savings. An increase in subprime, you see, like that's so dangerous. Can you imagine if you lended money to a person who has not a terrible credit score and a low savings amount? You don't trust that person because you know they're going to spend it in something unproductive. And that's what a lot of people were doing. Many waiters were owning properties, and the income that they were receiving in properties, they were buying Lamborghinis, cars, houses, boats, like just this stupid spending. And as the US government sponsored mortgage lender Federal Nation Mortgage Association, which is the Fannie Mae, began a concerted effort to make home loans more accessible to those with lower credit and savings than lenders typically required. Even the government was involved into this. You see, this literally comes to a point that you have to think independently from what the government even thinks, because this can happen again, because we're not ruled by some higher entity. We're ruled by human beings like us. Human beings make stupid mistakes, and that's why you have to invest in solid businesses that are not produced into their actual value just because of the government, or because of a niche where everyone is going, that people could potentially make more money. No, you want to look at something stable in where you get a product, it's valuable because many people like it, many people use it, it's a high productive value, what people need nowadays. And so, despite whatever happens, people still will consume it. But that's a big lesson because the government sponsored this. And I don't have a problem with the government sponsoring that because it's not a bad thing. The bad thing was a year later when a lot of these banks started to get very greedy and put a lot of their deposits into these mortgage-backed securities in subprime loans. That's a very stupid thing. And then the idea was to help everyone attain the American dream. You see, like the American dream of ownership, home ownership. Since these borrowers were considered high risk, their mortgages had unconventional terms that reflected that risk, such as higher interest rates and variable payments, while many saw great prosperity as the subprime market began to explode. Stupid. Others began to see red flags. I would have saw a red flag very early and potentially danger for the economy. Right? I would have saw a red flag if I had the knowledge right now. So the founder of Elliott Wave International consistently argued that the out-of-control mortgage market was a threat to the U.S. economy because the whole industry was dependent on ever-increasing property values. Out-of-the-control mortgage market was a big problem towards the U.S. economy because the entire industry was becoming dependent on just by increasing property values. And when you have those property occupants to be people who are easily able to default on their loans because they don't have a good credit and they have a lower amount of savings, meaning that they're likely going to default, you're going to get a terrible event to happen because they're the ones comprising it and all your occupants are like this. What will happen when that person can't get the property anymore? They're going to cash it out. And what do they have left? They have spending with their liabilities. That's gonna remember what happens to the economy when another person spends less, another person earns less, right? So if now they have to conserve their capital because they have to pay the bill what they have, and they're not able to do this. They're not able to. No one was buying houses now by that time. There was not much anything to buy because the prices were ridiculously higher. I mean, it was stupid. Like properties were worth 4 times of what they should be worth. It was this irrational property appreciation. Not because they were actual worth, but because everyone was going out of an incentive to just get easier loans. That's stupid. And Fannie Mae and another government-sponsored mortgage lender extended more than $3 trillion worth of mortgage credit in 2002. You see, and this is true, confidence is the only thing that was holding up that stupid house of cards. And the role of Fannie Mae and Freddie Mac is to repurchase mortgages from the lenders who originated them and make money when mortgage notes are paid. But what happens when they're not paid? You see, thus ever-increasing mortgage default rates led to a crippling decrease and revenue for these two companies, right? And what did these companies do? They stopped lending it out. And when there isn't much to lend, when everything's high, you have like somewhat of a depreciation, a deep depression. So among the most potential harmful of the mortgages offered to subprime borrowers were the interest-only ARM or ARM and the payment option ARM. Both were adjustable rates mortgages. So that's what it stands for, adjustable rates mortgages. These mortgages types allow the borrowers to make much lower initial payments than would be due under a fixed rate mortgage. After a period of time, often only 2 or 3 years, these arms reset after often at higher rates. The payments then fluctuate as frequently as monthly, sometimes resulting in much larger payments than those the borrowers paid initially. Oh my God. And then the uptrending market and growing house bubble that existed from 1999 through 2005, these mortgages were virtually risk free. Borrowers could end up with positive equity despite their low mortgage payments. Jeez, this is so stupid. This is like this is like a stupid casino. This is literally a casino where there isn't any, like it's a whole facilitated game. Their low mortgage payments because their homes had increased in value since the purchase date. If they could not afford the higher payments after the mortgage rates reset, they could just sell the homes for a profit. But what happens when you sell all homes and no one can buy it back? See what I mean? What happens when it's worth too much? You have inflation, right? However, many argued that these credit mortgages was a disaster waiting to happen in the event of a housing market downturn, which would put owners in a negative equity situation and made it impossible to sell. It's not because the mortgages here, like what it's saying. Yes, this was a harmful mortgages, but the whole reason what caused all of this is because you had stupid banks that became too greedy to utilize all their income, basically from their deposits, their liquid assets, and put it into these mortgage-backed securities. And this is what Lehman and Washington Mutual Bank did. Some other banks like JP Morgan did it. They didn't do it to the extent of Lehman because they obviously saw that there was risk, but they had a little, right? They had a little. There was a little in there because they still want clients and despite that. But you see, even trusted organizations, they're going to sometimes do a little. That's why it's called mismanagement. That's why you want to worry about the product. Because if you depend on management like that, sometimes you're going to get a stupid person out of nowhere and think that there's no harm in doing it, right? When you have a person that thinks that there's no harm in sniffing cocaine, right, until you see them 10 years later and they're involved in drugs and criminal activity, it's the same thing here. When you see that there's no value in product and management, when you rely on just management, it's a bigger risk when you invest in everything that relies on management, because if that person dies and a new manager comes in and that manager is a terrible manager, the business will go under and it will go bankrupt possibly, or it'll just do terribly bad. So the crisis of 2007 from an earlier expansion of mortgage credit, including to borrowers who were previously had a difficulty getting mortgages, which both contributed to and was facilitated by rapidly rising home prices. Historically, potential home buyers found it difficult to obtain mortgages, and if they had below average credit histories, provided small down payments or sought out high payment loans. Unless protected by government insurance, lenders often denied such mortgage requests. Jesus. So on top of this, they were leveraged to the bottom up and didn't even care that they would risk because they saw it's like that euphoria that they think that it's going to change the world. Nothing's going to happen, right? The risk is not there. I don't even care what the risk is because that's not going to happen, right? They're in denial. That's not going to happen. It's not. Everyone's going to use this. It's such a good idea and all this because there's such a good amount of money. And I see that the consumers there won't be any problem with property value. You want to get the hell away from those people because they don't think before they do things. They're now emotionally doing things before they think, or even after they think, or they don't even think at all, right? So while some high-risk families could obtain small-size mortgages backed up by the Federal Housing Administration, others facing limited credit options rented in that area. Home ownership fluctuated around 65%. Mortgage foreclosures rates were low, and home construction and house prices mainly reflected swings in mortgage interest and rates and income. In the early and mid 2000s, high-risk mortgages became available from lenders who funded mortgages by repackaging them into pools that were sold to investors in real estate. So new financial products were used to apportion these risks, with private label mortgage-backed securities providing most of the funding of subprime mortgages. The less vulnerable of these securities were viewed as having lower risk, either because they were insured with new financial instruments or because other securities would first absorb any loss on the underlying mortgages. That's actually what the banks do now, but it's not in securities. Banks have, for example, there's something called the Common Equity Tier 1. At least every big bank is required to have a Common Equity Tier 1. This was completely propelled after 2008 because what it does is that if a bank potentially goes through a possible bank run, which is terrible because when a bank run happens, when everyone wants to get their deposits, and every bank, the thing about banks is that banks are highly leveraged businesses. They're required to be so leveraged because what they do is the income that they receive, they either move it out in loans or they move it out in investments in securities. And that's important because that's how a bank makes money, right? And what the bank does is that they get people incentivized to get into this model either by having a money market fund, a money market account, and a savings account. That's how they pay you back. But the problem is that when everyone wants to get their money back, right? Because if you deposit $100 in the bank, depending what bank that is, but majority of every bank, majority, not every bank does this, but I would say in general, a lot of banks usually have a 1 to 10 ratio. What does that mean? That means that if you deposit $100 in a bank, they're likely going to take out $90 out of that and leverage it. Leverage it in loans or leverage it in securities. This is the problem that happened with Silicon Valley Bank. Why? Because what they did was they leverage it out, and there's no problem about leveraging. The problem is not leveraging out. That's perfectly fine because that's what you're supposed to do as a bank. That's how you make money. That's how you get a return and give the interest to the person in the account. That's how you sustain and make money as a bank. You're circulating the money. The problem is when you have too much leverage on one area. And that's what happened with Silicon Valley Bank. They had too much leverage in just securities, and that was specifically in bonds, right? And so when interest rates went up last year, the bond value went down. And the problem was that the bond value went down, right? Because you might be saying, but why don't they just hold it until maturity? Yes, that's what you're supposed to do in a bond. But the problem is that these idiots wanted their money in a year. I don't even get how this made sense. I don't even know how this came about in their head, but for some reason they decided to invest a lot of money into these bonds because they needed cash in 2 years for some reason in their business. And so when these marketable securities came down and they needed the cash immediately, they sold almost not all of them, but almost all of their securities in bonds for loss, and they lost billions of dollars. And that scared a lot of people in Silicon Valley Bank, and the bank had a bank run, right? And that happened recently. And fortunately, the Federal Reserve stepped in. It was potentially a bank run, right? But the Federal Reserve prevented it. The FDIC prevented it. That they said that, okay, the money is not lost. We're going to cover everyone's money, even if it exceeds the 200,000 amount, right? So the problem with Silicon Valley compared to Bank of America, because Bank of America is a highly consumer bank. You don't have people with high net worth in Bank of America. Usually you have a middle to poor class income families in Bank of America. That's why it makes a lot of money, because that's majority of everyone. But when you have a bank like Silicon Valley, where their bank is mostly comprised on startups that are not even profitable, these startups have venture capitalists that have millions of dollars. So your clients are mostly people who have millions of dollars in the bank. And if the bank goes through a bank run, you're not going to get your money back because it doesn't cover the FDIC. So that's why many people got scared and wanted their money out before it happened. And that ended up Silicon Valley losing a lot of money, and the government was forced to step in. That's what happened to Lehman. That's what happened to Washington Mutual Bank, just not with securities. It happened with loans. And those loans were subprime mortgages that had absolutely the highest risk possible of default, which is basically the person who was paying you back is not going to pay you anymore. That was the short of it. That's basically what happened. And that's what happened in 2007. And that's why it collapsed, because many of these people were involved into it. I mean, we're talking about the biggest banks. Like, think about if JP Morgan and Bank of America basically collapsed, that would affect the economy, because that's where everyone has their money, most of all. In these two banks, including companies. That would be a terrible situation. But is that likely to happen? Not at all, because Bank of America and JP Morgan don't have a risky loan. They don't have a risky investment. They're well balanced out in their investments. And back to common equity tier, which that was the whole point why I talked about this. Every bank has something called common equity tier 1. And common equity tier 1 is comprised of retained earnings and common stocks. So what that means is that if something happened like Silicon Valley, where the bank goes through a bank run, where everyone wants to get their money, you need to make sure that that bank has enough assets, liquid assets, to pay back every depositor that they have. And the good thing is that Bank of America and JP Morgan have super positive common equity tier. So if something happens, they're able to pay back every depositor. And in fact, JP Morgan has about almost double of what they have in depositors. That means if the depositors want their money, there won't be any worries, because JP Morgan has still double. Even if they sold half of their assets, they still have a big amount of assets left. That's the good thing with JP Morgan. Bank of America doesn't have double, but they have about 20 to 30%. Sometimes, again, this is 2023 in May. This can change next year or next 2 years. But because I know Bank of America and JP Morgan, they're not a type of bank, at least for right now, that are going to get anything involved into this, unless if someone, that would be very, very low, because it's a very reliable bank. That's why I don't invest in every bank. I don't invest in regional banks either, because they're much more riskier, because they're more comprised of people who are likely able to want their money back and default in what they're doing. And they tend to leverage out more because they're smaller banks. They're trying to compete against bigger banks. And they're not required by law to have a liquidity coverage ratio. And that's super risky. That's why I don't invest in regional banks, really. But yeah, that's what happened in 2007. In 2008, the market crashed. And you can already imagine the amount of pessimism, anything that was related to a bank. Even a person, why? Because people don't understand. Imagine you enter the market, you don't understand anything that's going on behind the scenes, and you start to sell because you see red candles. People tell you to sell because they're facilitating the game, and so you see like all this type of stuff. You get worse news and worse news until the worst of news, the market bottoms when no one expected to. People who sold here did not expect it would bottom over here, and hence, lo and behold, the market shot back up. Yeah, and a fun fact: JP Morgan, which I would have done the same thing if I was JP Morgan. When the Washington Mutual Bank failed, JP Morgan bought the Washington Mutual Bank. That's what happened with Credit Suisse. When Credit Suisse almost went bankrupt, I think it was called UBS, bought them. Yeah, so a combination of rising home prices, loose lending practices, and an increase in subprime mortgages pushed up real estate prices to ridiculous, unstable levels. Foreclosures and defaults crashed the housing markets, wiping out financial securities backed up by subprime mortgages. As banks began to fall like mosquitoes, the U.S. federal government was intervening to avoid a depression. Yeah, because that's similar to the the Great Depression. Only this time, the thing that saved a lot of different banks was the FDIC, right? If it wasn't for the FDIC, but this isn't even close to what happened in the Great Depression. Because at least in the Great Depression, you didn't have every single bank that was invested in the stock market. Only a few amount of banks were invested into unstable loans like the subprime mortgages and these mortgage-backed securities. This wouldn't have a big effect, but if the FDIC did not exist in 2008, there would be definitely a depression in the economy. And my God, if that would have happened, it would have been terrible. But my God, if that would have happened and I had the knowledge back then, I would be buying like crazy because I know it's going to go higher. That's the mentality that you need to have, because I know it will go down more the next, well, not know, right? I'm not predicting, but I'm just saying that, okay, if I'm buying here, I'm not going to be surprised if it goes down more. And if it goes down more, by all means, happen, because I want to buy cheaper. See, and that happens to me sometimes when I buy an investment, I kind of actually want it to go down because I want to buy it cheaper now. I want to buy it more. And many people don't understand that. And you need to have that mentality. When the stocks go down, you get happy because you're going to buy them at a cheaper price. When stocks go up, I mean, you see it as normal. You also get happy because your investments are valuing themselves. But I prefer it to go down because at least I'm getting a cheaper price that I know is very hard to get. Because when you buy a very good company, it's very hard that company is going to stay at that price in 3 years. Because it's a good company. It's making more and more and more money. But anyways, so you guys learned about 2008. That's what happened in 2008.